Hey there, everyone. My name is Ryan Schul. Welcome to my channel. So I just rebranded this thing literally today. It used to be called Straight Data Science. Now I'm calling this Analytics in Practice. And the reason for that is I just want this to be bigger than only data science. Okay, so data science is one little teeny tiny, itty bitty, little tiny itty bitty thing in the world, right? Analytics is a big monster, right? It's a behemoth. Data science is kind of small. And I was in the data science space for about 13 years, 12, almost 13, and had some great experiences, some of the best of my life, and some horrible experiences where people were just mean and nasty, very bitter, and always angry, lots of attitude, screaming and yelling. And I just don't want to be in that kind of environment. So if that defines data science, that's fine. You can be as angry and as nasty as you want, but myself and my channel are far bigger than that, right? We'll levitate over that. So also, like, I want to talk about topics that are not really relevant to data science or have nothing to do with data science whatsoever, because I think it's just a big world, guys. We live in a very, very big world. I don't want to be marginalized or excluded from a lot of things. So I'm taking the channel in a different direction. Still focus on Python, much bigger analytics in general, and not just little data science, which is teeny tiny. So in the topic today, I want to look at how much we should pay for a golf course. Okay, so my wife and son and I went golfing last Saturday, and I was just thinking to myself, like, how much is this property actually worth, right? Has nothing whatsoever to do with data science. Like, whatsoever, right? This is not a data science problem, but that's fine. I think it's an interesting question to ask. How much would you pay for a golf course? How much would you pay for anything, like any kind of enterprise, any kind of business, any kind of asset? Like, what is the asset worth? I want to get into more like maybe valuations, appraisals. What is something worth? Because what something is worth to one person, it might be different for another person. Might not be worth the same value, right? Something is worth only what somebody is willing to pay for that thing, and that's it, right? But you don't have to just randomly, haphazardly go into a business deal and say, well, I'm going to pay you $6 million for your golf course. I'm going to pay you $60 million for your golf course, right? You have to go in with intelligence, information, and make an informed decision, okay? So that's where I want to go today. I want to go with this thing today. So to make investment decisions, I think that's very important. And if you're unscrupulous, you can do this whole analysis and you can say, okay, the golf course is worth 20 million. I'm going to offer this guy 8 million and make up some weird scenario and try to prove to him, okay, your golf course is really worth 8 million, even though inherently you know it's worth 20, and you underbid and maybe dupe the person and trick them into selling the asset. Like, that's not what I'm talking about. That's not what I'm trying to motivate here. But to make like a truly informed decision based on finance, based on data, based on information, and based on analysis, right? So we can make intelligent investment decisions. For finance and lending purposes, if we have to go to a bank, we're going to have to put together a proposal for that bank and say, listen, I need to borrow some money, so this is why I can justify the golf courses with this amount, worth this amount, right? Strategic planning for the owners. Maybe the owners want to do this exercise and say to themselves, like, what is this property worth? And there could be other things going on. Maybe the golf course isn't generating a whole lot of revenue. Maybe you want to sell it to a developer. They're going to come in and build some houses on that property. So I don't even know legally if that's even possible. Maybe by law or by, what is it called? Property rights or jurisdiction, zoning. I think zoning is the word. Maybe by zoning ordinances, you have to keep that as a golf course. Maybe you cannot sell it to a developer, okay? Because I don't know the legal ramifications of that, but I'll show you the math and the statistics and the financial proof in just a moment. So maybe there's an exit strategy and a sale preparation, right? Maybe you can sell the golf course, maybe you can't. I'm not sure, but we will figure out how much this thing is worth. Operational benchmarking. Should you continue in perpetuity to operate as a golf course? Yes or no, probably, but maybe not. Real estate and zoning angles, okay. Risk management, investor reporting, and governance. So that's important as well. Negotiation with stakeholders. Maybe there's other people, some kind of consortium that has invested in your business as a golf course, and you have to report to them, like, what's going on with the business, right? How is the operation holding up over time? So there's a holistic value perspective. We're going to look at that. DCF is discounted cash flow. This is the operations of the business. Comps, like if you have other similar golf courses, kind of similar to your own, you can use a comp as a comparable. It's short for comparable. And this other golf course is worth X amount of dollars, 10, 11, 12 million dollars, whatever it is, and yours is substantially similar, so it's going to be worth probably the same, right? Land or alternate use value. Again, you may or may not be able to repurpose the land. There could be legal ramifications for that. I just don't know about that. Combining all these principles together to make sure that we have a holistic, non-biased answer for how much this golf course is worth, right? So it's not just discounted cash flow, it's not just comps, it's not just land, but it's all these things combined, right? So it's holistic, and it's actually a little bit complicated, but we'll peel back the layers of complexity and answer this question: how much is the golf course worth? So let's take a very simple perspective here and say, okay, we're going to operate at scale for another 10 years, and we're going to make about 40,000. People will pay about 40,000 to play golf in our golf course in year one. Okay, the annual growth is going to be about 1%, give or take. Average fee per public meter is about $65, and the green fee growth, this is the change over time, is about 2%. Now you can see how all of this is going to come into play very quickly here. So these variables, you have to determine this. I can't say the year one operating revenue for your golf course is 40,000 or 400,000. Like, you have to do a little bit of homework, some estimation, work with some valuation professionals or appraisers maybe, and just try to estimate these numbers. But once you put this into the model is going to crank out an answer for you, right? So if the year round, year one round fees that you receive, right, paid fees to you is 40,000, then the golf course is worth X amount of dollars, right? If it's 400,000, that's going to be 10 times more, almost a 10-time multiple more, right? But it's more complicated than that. There's other things that come into the equation here. You can get membership fees, $350 per year for a membership fee to play as much as you want. Membership growth, maybe 0%. You can change that. Again, these are all variables. You can change it to be whatever you want. So dues is $3,000 in this case. I think all of this is pretty realistic, but again, it really depends on your inputs. Your inputs will drive your outputs, right? If you want to change any of these numbers, by all means, go for it, but it has to be somewhat realistic to get a realistic appraisal here, okay? So food and beverage and other events, you could have weddings. If you have a nice country club, you can have holiday parties or whatever, right? So you have to determine what these numbers are. So revenue per round, $14, I'm going to say. And this is revenue growth. This is EBITDA. So this is earnings before interest, taxes, depreciation, and amortization, and food and beverage. So this is the margin. This is how much profit you're making. If you put in $100 an investment, you're going to make $25, right? So 125 or 25 is the profit, right? But again, this EBITDA, if you don't know what that is, you have to Google it, look it up. This is earnings before taxes, before interest, taxes, depreciation, and amortization. So it's a finance term. It's also an accounting term. Look these things up if you don't understand it. I think this analysis is pretty relevant and pretty realistic. So year one event revenue, $350K, event revenue growth 2%, and event margin 35%. So every $100 you pump into the business, you're going to make up $35. So other revenue growth, I'm saying $450K, or year one revenue, $450K of other revenue growth, 2%, other margin, 45%, okay? Base operating margin is 45%, admin fixed costs. So this is sales growth and, selling general administrative overhead expenses. SG&A is selling general administrative. So it costs money to operate the business, right? You're going to have some fixed costs and some operating costs as well. So here's the CapEx. So capital expenses are what you pump into the business, right? So this could be greens, irrigation, clubhouse, something that's fixed and tangible that you can put a finger on. We also have working capital. I'm going to say working capital percent is 3, taxes and discounting. And you can have operating expenses, right? So capital expenses are investing into the business, into the infrastructure, into renovations, greens, irrigation, clubhouse, because things fall into a state of disrepair over time, right? You have to put money into it to bring that back to a normal operating state. OPEX is a little bit different, right? This is more like the cost for electricity. If you want to do business, what does it cost to operate the business, right? So you have CapEx and OPEX. You have to break those down. And a couple other appraisals down here is the overall acreage, land value per acre, zoning, factors, closure costs, sales costs. So if you're going to sell the business, how much is it going to cost to do this transaction? And comps, multiple low and high, because there's always going to be like a kind of like a little bit of a friction here. You can't negotiate everything extremely precisely. We're going to try to come up with an estimate, but you can't say the golf course is absolutely 100% worth this amount, right? There's kind of give and take, and there's still buffers, and there's some friction in between. So let's build a DCF projection. So this is discounted cash flow projection. After year one, we have rounds, average fee, members due, food and beverage, events, other admin costs, right? There's fees for the running the greens membership, food and beverage, other, and events. We get a total revenue here. There's other EBITDA and event EBITDA as well, okay? And we have gross revenue and core OPEX, right? So again, if you don't understand this terminology, EBITDA and OPEX and CapEx, go ahead and Google those things. You're going to learn a ton. If you know what it is, and you already know. If you don't know, Google it, do some research, and you're going to find out. And it's going to be a very enlightening experience. So we have EBITDA and tax down here, net operating profit after tax. Now we're going to take all of this and append this to a list called rows. If I look for that, you'll see the list is defined right up here in the square brackets. This is a data type of a list, right? In Python, we have 4 major data types: list, a tuple, a dictionary, and a data frame. So we're going to take all of these different features right here that we just calculated, append each one to a list, right? All the rows are appended to a list, and then we convert the list into a data frame, and you can see the data frame down here. So I just hit Control Enter. I'll do it one more time just to make sure, just for peace of mind over here. Okay, so we get down to our data frame, and this is what it looks like. Okay, so these are the features that we just created: rounds, green fees, membership, and so on and so forth. We have our financial items over here: net operating profit after tax, CapEx total, and net working capital, change in net working capital, and free cash flow to the firm. So FCFF is free cash flow to the firm. This is how much we're making as a business, right? So as an ongoing business in perpetuity, this is what we're going to make. So we're going to put all of this into working capital, look at the discounting of these free cash flows, and then determine the value of the business, right? So if you don't understand it, totally fine. I get it. I have my master's in finance. I understand this stuff pretty well. It still took me a lot of time to put this analysis together. But if you don't understand some of these terms, just go ahead and Google it. If you have some comments, post comments in the comment section. I wouldn't suggest like asking a lot of questions in the comment section, because I'm pretty busy. I don't get back to all those things. If you Google it or go to ChatGPT, that is a great resource as well. And there's a lot of tools out there. Just by Googling, you can find a lot of information. And I think it's going to be a very informative experience for you, right? So we're going to put all this into the model, hit Control Enter to run the model. And the model says this business is worth about 12.7 million. This is rounding off. This goes right down to the penny down here. This is rounding off. So about 12.7 million. Now, again, I can't say this is absolutely 100% gospel truth. Is this golf course actually worth 12.1 million? It depends on your input. So you have to understand the inputs to get an accurate output. The rounds per year, the rounds growth, average green fees, green fee growth, right? If I put a different number in here, Control Enter, run it, and then do the discounted cash flow in the model, it's going to come up with a bigger number than 12 million, right? Because now I'm saying the business is generating a lot more revenue. Now with this golf course is worth 121 million, right? Just by changing one number, by changing one input. But you have to think to yourself, is that realistic? Like, how much are you generating from rounds per year for the golf course. Now, I understand there's other income sources, right? Food and beverage, events. You can have weddings. You can have holiday parties. But there's cost to doing business, right? You have your CapEx, you have your OpEx. This is the year one round, paid rounds in year one. If you truly think this is around 40,000, and I don't know, when my family and I went to go play golf last Saturday, I have no idea. I didn't look at the guy's books and records. I don't know if he's making 40,000 or 400,000. But you, as a business owner or as the investor, you have to do your due diligence and say, what are these numbers, right? Once you get the numbers, you can plug it into the model and you can get the output. I think this is realistic. The course I played at is in Queens, New York. The property over there is pretty pricey. Very, very small course, 18 holes, but the longest distance from the tee to the flag was like 80 yards, and the shortest was 40, right? This is called a pitch and putt. So pretty small piece of land. I think these numbers are pretty realistic. I think the course is worth about 12 million, a little bit more, 12.7 makes sense to me. But again, you have to use your analysis, your numbers, and common sense needs to be applied. If you think that these numbers are right, then the model is going to take everything right here. It's going to spit out a number. That's what the golf course is worth, right? If you think the numbers are different, then they're different. You have to use some judgment here and apply common sense. So now let's look at the appraisal of the land itself. So we're going to look at the overall acreage, sales cost, right? Unless you are in the business of professionally selling golf courses, you probably have to hire somebody to work with you to assist you, and there's going to be costs associated with that. What is the net cost? And we can go ahead and appraise the value of the land or try to determine what is the land actually worth, right? So we need, again, EBITDA, low, high, and then calculate the returns, right? And get a stable EBITDA. Let me hit Control Enter to refresh the cell. And then we come up with the enterprise DCF. This is discounted cash flow, EBITDA, present value of the terminal value. So that is what the end value is worth. But today, because this transaction is going to occur in the future, we want the stable DCF. Comps, land gross sale, net debt. Is there going to be some debt for this transaction? Equity value, this is the discounted cash flow minus the debt and the equity value. So we could go ahead again, put this into a list, convert the list into a data frame, and come up with this right here. And we have the metrics and the amounts. So this is the enterprise value, DCF, present value of terminal value, net debt, and so on and so forth. And these numbers are all scientific notation. So I did a little conversion over here just to get it into a format that is a little bit more readable by a human. If you look close, these numbers are going to be the same, 1.27 with an exponent to the power of 7. So this is equivalent to 12.7 million, right? So here's 1.689, 16.895 million. This is 108 down here, 108 to the power of 5, and 1.18 to the power of 7. So 11.84 million for equity value plus the land, right? And that should be probably pretty close to this, right? It's off a little bit because this enterprise is earning money as a business continuing in perpetuity. This is a little bit less. This is just the equity value of the land itself. So let's go ahead and create some plots and charts. I always say a picture is worth 1,000 words. I like these Plotly charts a lot. I always go to this. This is my default Plotly because you can zoom in, you can zoom out, you can put your mouse over the plot and the tooltip will pop up, right? If I zoom in over here, I can see the details and double click and I get back to the original view. But you can see how this is changing over time, right? So the events and revenue actually generates pretty good income over here, about 418,000 10 years into the future. Today, it's about 350,000, right? And you can turn these on or turn these off as well. If you see that the red disappears or reappears, this is the green fee revenue, right? So the greens make up most of the revenue. This is about 2.6 million year one, 3.3 and 10 years out because basically of inflation and the growth of the business. So the land probably won't grow per se, probably won't expand, but your business could expand through some marketing, advertising, word of mouth. As long as you are treating people well, probably the business is going to grow over time, right? Just marginally. We bake that all into the original analysis. If you think the business might decline, that could happen. That could certainly happen. Businesses go belly up all the time. But probably if you're doing a good job, whatever it is you're doing, it's probably going to increase a little bit over time just due to inflation and word of mouth, and the business is going to grow. So anyways, you can see most of the revenue comes from greens fees, right? 2.6 million. The red is the membership revenue, 1.5 million. 560,000 for the food and beverage. Events, 350,000. Other revenues, kind of going off that chart here. Let me try to expand this a little bit. Okay. What was the last one here? So, lost it. Okay, yeah, other revenue, 450,000. Then go up to year 10, and you can see all of these are pretty much going up. But again, that is the assumption that we made. We added a small percent increase, 1 or 2% increase for each of these. So over 10 years, it's going to increase. If you actually think other revenue could decrease, then you have to make that an assumption and put that into the model, right? The model is just doing what you tell it to do. It doesn't know anything. It's not an intelligent model. It's basically a classical discounted cash flow model, right? And we're making estimates of revenues projected into the future. So if you think green fees are going to decrease for whatever reason, you have to put that into the model because the model isn't going to know. If you tell it 1% increase per year for 10 years, then that's what it is, right? And it's probably realistic. You have to think about what's happened in the past and make projections into the future, right? That's how these things work. So we have the total EBITDA margin. So this is earnings before taxes, interest, earnings before interest, taxes, depreciation, and amortization. And you can see the EBITDA margin is pretty flat. Total revenue is increasing over time. Okay, that's the assumption that we made. Cash flow, this is 5 years out. You can see the EBITDA is 2.09 million, goes down a little bit by 1.87 due to depreciation and amortization, right? So everything is going to depreciate over time. This is a tax write-off. The land, I forgot if you can depreciate land. I don't think you can. But any kind of man-made physical property, the clubhouse, even the glasses, the silverware in the clubhouse where people are eating, and things like this, the bar, if you have a bar, all these assets are going to depreciate over time. You're going to have to replenish those, right? So you can take the tax write-off. So a little bit more depreciation. So this is EBITDA depreciation equals EBIT minus taxes, and then non-cash depreciation gives you a sustaining CapEx. This is a capital expenses, right? This is for investing in the hardware of the business, mostly the clubhouse and the greens, and maybe those little rakes that go around the sand, and probably a tractor or whatever lawnmower. You're gonna have to mow the grass at some point. Major CapEx, pretty minimal over here. Change in net working capital, pretty tiny. And the free cash flow to your business is 1.4 million per year. The present value, including the terminal value, these are the values per year, okay, over time. There's a little bit of a dip over here in year 4. There's some kind of capital investment. Probably in OpEx, probably more CapEx, depreciation and amortization, things like that. And the terminal value over here is about 5.95 million, almost 6 million. This is a sensitivity chart, so we can see the exit multiple over here is increasing over time, or actually decreasing, as the WACC, this is the weighted average cost of capital, increases, the enterprise value sensitivity changes, right? So here we have a 9 times. If the WACC is only 8%, if the WACC goes up double to 16%, then the enterprise value decreases quite substantially. Here it's worth 10.4 million. Over here it's worth 17 million. If you go up to an exit multiple of only 5 times, right? So a smaller exit multiple, here the business is worth 12 million, 12.9, almost 13. And over here, it's only worth 8.2 million. So again, these are assumptions that you come up with. You have to understand your WACC, your NPV, your IRR, things like this, the cost of doing business, your CapEx, your OpEx, things like this. Once you know that, you can make very, very intelligent assumptions about what this business is going to be worth today and into the future as well. If you don't understand these terms, then again, I encourage you to Google it, look it up. There's a ton of information on Google. There's all kinds of books you can read. Take a course in college on this stuff if you don't understand it. I think it's very interesting, very fascinating. And very practical tool. And if you want to make money in this world, you really have to understand this stuff, right? There's an old saying, it's something like money flows from those who don't know to those who know, or something like that. I probably butchered that. But if you don't know this stuff, you're probably going to lose money. If you know how this stuff works, you're probably going to make a lot of money. Okay, so education is expensive. You can go to school and get a college degree in finance. You can go read a bunch of books and learn on your own. You don't have to take any classes. You can be all self-taught if you're motivated for that. But education is expensive, right? So you will be educated one way or another, either through a formal means, a college course or a college degree, maybe, or reading several books, or you don't know and somebody takes advantage of you, and then you realize what happened, and that's your education, and that's expensive too. So I'm going to take all of this as a final step, Control Enter, export this to an Excel spreadsheet, just so I can go ahead and share that spreadsheet with my stakeholders, with my investors, with my board of directors, things like that. I'm going to download this code as an HTML file, and I'm going to share that with you guys. Okay, so you have all the source code that you need. You can go ahead and run your own analysis. Let's take a quick look at this valuation that I just exported to Excel. Right, here's one key takeaway right here that you can also share with your stakeholders. Right. So my Excel is opening right now. That's good. Okay, this is what we end up with after it's all said and done. So let me expand this a little bit. This one too. Okay, so here's the number of years. We're looking 10 years out. Here's all the values that we just calculated, simply exported to Excel. These are the assumptions that we made, right? So go back and look at this. This is year one round in 10 years, right? If you don't know what this is, go back and look at the source. Okay, that's over here. Computers get funky now. I don't know why it does these things. Like, it doesn't really do what I tell it to do all the time. Sometimes it does, sometimes it doesn't. Okay, so this is 10 years out, 40,000, growth 1%. Here's the growth. Average green fee 65. There's your 65, and green fee growth 0.02. Right, so these are all the assumptions that we originally came up with. So I just put that into Excel. I just exported all the assumptions. These are the DCF projections, so discounted cash flow projected over time for 10 years. Okay, so we have the greens, fees, members, dues, everything like that. So that is all exported to Excel, so very nice. And then if we wanted to create a chart, this is the free cash flow over time from year 0 to year 1. So I can go ahead and plot that, insert. Let me get a normal line plot. I think this is sufficient here. So here's the free cash flow over time, right? There's a dip down here. There's assumption of a CapEx investment. You're going to have to take some of the revenue from the golf course and invest that for some upgrades. This is the DCF discounted cash flow, and here's a summary of everything. These are the metrics that we're looking at, and these are the actual amounts and actual numbers, right? So, and then of course you can plot that. Maybe a bar chart would be relevant over here. Let me see if that's, see what this thing looks like. That's a box chart. Oh, wait, here, maybe this one. And we have nothing. That's interesting. Not sure why that's nothing. Let me try it one more time. I think, right? I haven't used Excel in a long time. I thought that was a good chart. I don't think it's going to be a line. I don't think it's going to be that. Oh wait, I think these aren't real numbers. I have to convert that to a number. Okay, that came out as text. That's fine. Okay, so let's go over here. Yeah, here we go. So there's the chart. Okay, anyways, guys. So that's it. I just wanted to take you through the process there. Let me close this. I already saved all the source code. I will share all the source code with you guys when I post the video, which will be a little bit later today. That's it. How much should you pay for the golf course? That's it, guys. That's how much you should pay. In this case, 12.7 million. But again, it depends on all these assumptions that you come up with, right? So you have to work with a valuation expert, some type of golf project planner or project manager, business analyst focusing on golf courses to get some accurate multiples here, and probably one or two financial professionals to add some advice and some sanity checks and bounce some ideas off of. But that's it. You just put the numbers into the model, crank out the DCF, get the valuation done, and then you can buy your own golf course if you want, if that's your thing. And it can be any kind of asset in the world. You can imagine some rare art, a house. You can buy whatever you want, like a power plant, an array of solar cells, or a wind farm, or an agricultural farm, or who knows, a museum, whatever you want, right? You look at the operating cash flows, you look at the free cash flow to the firm, discount that, right, to get the present value of that enterprise. And that's what the thing is worth. That's literally what it's worth. I just love doing the golf course because I went golfing last Saturday, had a ton of fun with my family. That's how I came up with golf course. But these principles can be applied to anything on planet Earth. Any kind of asset that you want to buy, you can buy it, right? You just have to come up with realistic, accurate estimates for these inputs and calculate the output. That's it, guys. I'm going to wrap it up. We are at 31 minutes. This went on a little bit longer than I had planned for, but that's totally fine. It is what it is. You have everything you need. I'm going to share the source code with you when I post a video later today. Thanks for your time. I'll see you in the next one. Goodbye for now.